And now we have the pleasure to welcome Zach Abraham from Know Your Risk Radio, and he's the CIO of Bulwark Investment Management. Zach, it's a pleasure to have you here.
Hey, pleasure to be here, guys. I've been looking forward to this. Big fan of the show, and it's the funnest podcast for sure.
Yeah.
I really enjoy it.
So I was kind of laughing because usually you're the guy asking the questions. I've been on your show a couple of times. It's always been a lot of fun. You've always we've enjoyed chatting about the market, and now I figured it's time to turn the table and ask you what you think about the market. The S&P is hitting new highs here. You're always one, that's willing to kind of stick your neck out and say something provocative and exciting. What do you think about this S&P up here?
I think it's patently insane. I think it'll be interesting to say we're talking 20 minutes from the close right here. 30.20 has been a technical level that we've been watching for a variety of different reasons. We're sitting at 30.27. But the other side of it is it's probably about 3 or 4 years ago, honestly, I looked at it and said, look, this is going to be a different kind of deal. This is not your garden variety bull market, obviously, on so many different levels. And, one of the things we've talked to our clients about is, it just looks so primed to roll over. And I think I really think that it could, not saying I'm predicting that at all, but it could make 2008, 2009 look like a picnic for a variety of different reasons. Yeah. How's that for hyperbolic, right?
I love it.
But then again, I wouldn't be shocked to see us go full blow off or what we refer to as retard mode. That's not politically correct, but you guys don't have to deal with the FCC like I do. So, but yeah, I wouldn't be surprised to see us tack on another 30% from here. I mean, why not, right?
Really? So you're in that camp where we're going, let's say, 3,400, 3,600 on the S&P. It's just going to go retard mode on the upside, and then we're going to blow off on the downside. I can't believe I'm using the word, but okay.
You guys. Okay, listen, it's Kev Gutty in here. As the sober Canadian, I have to say we have to stop using that. It's not appropriate, boys. No more. Okay, leave that one aside. Let's just leave that aside. I'm sure we can figure out something insane or something more
edit
appropriate.
Out.
No. Anyways,
my wife is going to hear this and slap me for that.
Your wife listens because mine doesn't listen to anything I do. But
Neither
anyway,
does mine.
Let's go on. So you think that the market's super extended. I know we've talked a lot about the debt levels. You're one of those guys that's worried about it. You think that it can't, this has got to end badly. You're looking at all these things. What sort of stuff are you watching that's kind of giving you the greatest cause for concern?
I think it's being more of a classical value guy. Which, needless to say, has been like surviving a nuclear winter these last 5 or 6 years. But just the extension. I just got done doing an interview with Jesse Felder, and we were talking about some of the, some of the bellwethers, even like a McDonald's. Kevin, I know you and I spoke about Boeing extensively back before the trouble started in February. Just looking at the fundamentals in relation to the price that we're paying. And then not even really considering the debt in this situation. There's so many of these, Coca-Cola. Revenues are down something like 25% over the last 3 years, and they're trading at a 34 or 35 multiple. Yeah. McDonald's at a 30 PE. This is just nuts. It's not how, in my opinion, and I can be wrong. God knows it's happened before, but on a fundamental level, you look at it and just go, look, it's not if you're going to lose money if you're long these names, it's when,
And do you think it's the whole market, or do you think it's specific to those kind of defensive names that people are chasing in an attempt to try to figure out a way to replace what used to be, used to get from fixed income? It used to be you could go buy a bond, a 10-year that might yield you 4 or 5%, and now you can't find that. So people are rushing into these kind of high dividend paying stocks as a kind of a proxy for that.
Well, that's a funny one, right? Just the word fixed income. Now in a lot of places, it's fixed expense, right? We're not even getting income.
I've never heard that used, but that's awesome.
Well, you look, there's just these anomalies everywhere where, and look, man, we're all in a performance-based business. So you feel the pressure of wanting to run after it and catch up, but you just know that you can't do it. And I see it all over the place. The one place we're finding value right now, perceived value, we'll see how it plays out. I feel like an idiot a little bit. You feel like you're running into the fire. But retail, I mean, that's really the only place we're seeing substantial value, honestly.
You don't think the energy sector has some value?
Oh yes, okay. So I take that back. I think that things, especially if you've got the outlook, which I do, of a stagflationary slash inflationary environment kind of going to be the next role, there are some energy names that look attractive to us, a couple that we've added recently and that we're looking at. There definitely is there. I think that kind of what happened in 2015, 2016 really cleared out some of the muck, and there is some attractive names there. But just in general, like I said, we hired a new, so funny deal. My uncle used to run a money management firm down in Panama, and they specialized in special resources. They did a lot of different deals with Rick Rule and Sprott, and he had about 25 brokers working for him. And he recently came on as an advisor to our firm because he sold his firm about 4 or 5 years ago, and I kind of coaxed him out of retirement. And we're driving down the freeway, and he looks at me and he goes, "Why aren't you just focused on the classic value names? Just write it out." And I go, "Like what?" And he started pulling them out, Procter and Gamble, McDonald's, and I just started ripping through them one at a time and going, "There's no value there."
Right.
It's insane. And that, I think that is really I think that the way that you guys talk about it being some value in miners on the gold side, I think there's clearly some value there as well, on the energy side. But I mean, you get outside of those few pockets, and it just, you can't pencil it, right? You can't even I can't even make an argument of why I would justify going into those things. It's just, you kind of feel like your hands are tied, at least
So,
from our perspective.
so what do you see on the retailers that's exciting you?
Well, one that I recently did a podcast with Toby Carlisle. I was on his podcast, and I hate to talk about it because it's been a house of pain for us. But there's a company called Tailored Brands, and everybody knows
What's
them.
the symbol on it?
TLRD. And if you look at, so if you don't know it, you do. Buy 3 suits, get 1 free. Joseph A. Bank.
Okay.
Oh, I know Joseph
Right?
A. Banks. Oh, yeah. So they bought
There you go.
Joseph. Yeah, okay. Oh my God,
Yeah,
it is a house of pain. I can see the chart already.
yeah. So that first crossed our blotter, I want to say, and don't quote me, around 2015, and we got in at an average price of right around $13 a share. I want to say we had a fair value target on it at 29. It hit our target. We sold it. We held it for, I want to say, 16 to 18 months. And then I did what I almost never do, which is it got hammered again. And we staged in our, thank God, we staged in our purchases, and took a stake down at 13, picked up some more at 8, and picked up a little more at 5. And the thing is just getting crucified on the short side. It's got some fleas. There's no question about it. But if you guys want to get into that, we can talk about the reasons why we think it's way overcooked to the downside. But essentially, you've got a company that's cranking out somewhere between 150 to 200 million in free cash flow with a $235 million market cap.
And what's the bear argument? Like where do you differ from the bears? Like what do you see that's different than what the bears think?
It's funny you ask that because we've spent a lot of time researching the bear thesis. The bear thesis is it's going bankrupt, and it's a flawed business model because you can't sell 3 suits for 1. So let's start there. They no longer do that. They quit doing that almost 3.5 years ago. I was reading a bear newsletter that came out just a month ago on why it was a sell, and they were citing that. Well, they haven't been doing that for 3.5 years. Now, the acquisition they made of Joseph A. Bank was an absolute disaster. They way overpaid for it, and everybody cites the decline in revenues, but the decline in revenues for the entire company is almost solely attributable to Joseph A. Bank. The core business, the real value we see, is Men's Warehouse, and they've really muddled through this whole retail apocalypse pretty cleanly. And one of the thesis we had, or part of the thesis we had getting into it, was, look, yeah, retail is going to get pressed. The Amazon effect, the internet, I get it. But men's suits are something that not a lot of guys are going to start buying online. There are some, but we thought it was going to be one of the most durable sectors. as it relates to Men's Warehouse, that's been the case. It's been very steady.
Right.
And it's a cash flowing machine. One of the reasons for it is they're not a true retailer in the sense that they're not selling other people's goods, they're selling their own. They've got several other brands in there that aren't even figured into the calculation, like K&G and Moore's. And I haven't done a deep dive on those. Those don't look like great businesses, but they've got some that are, like Joseph Abboud. They own that brand. I think it's a great brand. I own some Joseph Abboud suits, love them. And so this thing has gotten crucified because it's going out of business. And I was talking to Toby Carlisle, looking at the fact that they're paying a 14% dividend right now just because the stock's been beat up so bad. And I'm really hoping that an activist investor gets in there, because the company also has, and again, don't quote me, I don't have my notes right in front of me on this, but they've got a $450 million revolver that's available. I mean, they could, and I think their cost on that is like 6.5 to 7% a year, or less than half of what their dividend rate is. This is a company that could step up and buy 100% of their equity themselves, and improve cash flows at the same time, because they wouldn't be paying the dividend on those stocks or on the shares, right? So,
Right.
you know, it's not fun. I've gotten a lot of client calls. It reminds me of Top Gun. Where you're gonna do what? Um, so,
So
but
One sec.
we've done our research and we like it.
Yeah. So one of the things you mentioned is you brought up Amazon. Now, being from Seattle, like you are headquartered in Seattle, is that correct?
Yep.
Yeah. So you must have kind of an opinion and like a on the ground kind of opinion on Amazon. Why don't you walk us through what you think on that stock and the whole kind of what they've done to the rest of retail? Is it
Okay. Well, yeah, that's a tale of two cities, because I think it's an incredible company. I have been wrong about Amazon for a very long time. And then about the time that I swung, which is probably 5 years ago, I kept setting entry points and would just miss them. So this is not sour grapes. I'll be the first to tell you I missed it. And then on top of that, every time I come home, I see 4 different Amazon boxes sitting on my front doorstep. So it's like a recurring slap in the face, right? But
I get
I
that all
think,
the time from my wife.
yeah, yeah. So it's a I think that I think that there's, and again, I've talked to Toby and I were talking about this on his podcast too. I think there's a big leap of faith if you look at a lot of the growth that's built into that story, or a lot of the juice that's built into the price of their stock. Everybody goes back to AWS, and I think that this whole cloud computing rage reminds me so much of telecom in the late 90s, meaning that it's all the rage right now because everybody's got pricing power, right? Because everybody's flooding into this space, but it's just primed to be commoditized, in my opinion. And I just see that, I see these margins slipping. The first, when we get into an environment where they're battling for business with each other, it's just going to turn into a price war. I mean, there's so little differentiation between the offerings that all of these cloud computing type companies are delivering right now. And they're great businesses, man. We use it. I'm not knocking it. It just is the prime setup to me, where we're extrapolating out these profits and these margins, and it's not going to hold. There's just no way. I mean, they've got all these server farms. The minute you get into an economically depressed cycle, they've got to. The more people they add to those server farms, right, the better it is. So it's just going to turn into a price war. That's at least the way it seems to me. And I just don't think that their price or their current valuation is sustainable at all.
So it's one of those classic examples where the market is extrapolated way farther in the future than the reality could ever imagine. Now, the other one that we talk about extrapolating farther in the future is Beyond Meat. What do you think about that? Like, that's another kind of crazy name, right?
Yeah. Can we? Yeah. Well, and we're not governed by, but I think it's a shit show. I mean, it's a
Yeah,
dumpster
you can
fire.
say it's not. We swear all the time, so go crazy, buddy.
Okay. Yeah. So and I got to stretch that out because, like I said, I'm not under FCC rules right now. So we got in this exchange on Twitter, and he was passing around. Funny enough, he was doing it with David Rosenberg, which I thought, okay, this isn't going to go over very well. But he was trying David to read his 10-year projections for Beyond Meat. And my first response, and again, not to be a jerk, because we've all been wrong, but I said my first thought was something tells me that this cat did not manage money through 2008, 2009. And second of all, a 10-year projection isn't worth the paper it's written on, right? And I mean, the fact that anybody is really debating this when you look at the underlying fundamentals, it's just nuts. And we don't even need to get into the fact that they've got no IP, right? The whole story is everybody loves this product. McDonald's and Burger King if this really takes off and it's a trend, do you think McDonald's and Burger King are going to keep buying that from them? No way. They're gonna develop it on their own. I mean, it's a poster child for the price insensitive insanity that we see all along. But other than that, I'm really bullish the stock market.
You, I'm feeling so much conflict there. But anyway,
Yeah.
How high do you think this insanity goes on Beyond Meat? I mean, are we going parabolic here, where it first goes to 300? Because me and Kev are going to be talking about this a little bit later on from the options perspective. But what is this? How crazy does crazy get here? I mean, do you think that this still can pull a Chipotle and just keep ripping to 300, 400, 500, not based on many valuations. Clearly, you can't justify that. But like, we're just talking about pure momentum of the animal spirits of insanity. I guess you can put it there.
Yeah. Well, I really don't. I feel like it's going to go higher. I mean, that's just kind of my gut. I feel like that's kind of the same with the market. And we have a joke around the office that it's sort of like traveling to the moon, right? Whether you're off 1 degree or 20, the result's the same. And so, what prevents? Why not 400? Why not 5? I mean, why not? I don't. I can't even begin to get my head around the valuation. So my initial response is higher, right? Look at Shopify, for God's sake. I mean, why
Hey,
not?
be careful now. That's a good Canadian company.
Oh my
Yeah,
god!
no, go ahead.
But you know what's interesting is that Beyond Meat just passed the market capitalization of Campbell Soup, right? Like, no, but did.
Campbell
It's now
Soup's
got a higher
100-year-old
market
company or
cap.
something like that. It's not
Sorry?
been around very long. It's an unproven concept.
Yeah. There was a fascinating one that I put out the other day that I kind of ran across, and I just thought it was incredible. So last year, Kirkland Signature Brands, right? Costco's proprietary brand, they sold 45. They did 45 billion in revenue through Kirkland Signature Brands alone, right? Last year, Beyond Meat did 95. I want to say this year they're slated to do like 120 million in revenue, and then you start comparing that kind of valuation. You look at what that kind of valuation they're throwing on Beyond Meat and what people are projecting out here. And again, it's not a like for like comparison, but at least to me, it provides scale. And it's just shocking. I mean, do they think that Beyond Meat? Because if you're buying it here, you have to be, right. You've got to be thinking that it's going to be on par with like a Kirkland Signature or something like that.
Yeah.
For
And
sure.
it just defies logic.
Okay, so I want to interrupt here and talk a little bit about what you're seeing on your retail clients. Like you're actually talking to retail clients and you're seeing the pressures they face in terms of saving. Are you finding that they're chasing stocks up here, or do you find that they're kind of wanting to like step back and say I want to sell? Like what are you seeing on the retail side?
So there's so much, and I don't doubt the data, and I think a lot of the guys that are putting out this, I respect it. If you guys know, if you do this long enough, you learn to really respect anybody's opinion because God knows, right? Anybody can. But there's all this talk about all these withdrawals from mutual funds. I don't know what's causing that. What I do know is that I've been doing this now for 13 years, and I have never seen retail investors as bullish as they have been in the last 6 months. It was kind of like that
Really?
last year oh,
Yeah.
100%. They want pedal to the metal. And it's like that last blip we had at the end of 2018 there was the straw that broke the camel's back, and they feel bulletproof. And we've been lucky enough to have some great investors that came to us. We don't make any bones about our approach. We come right out in front and say, look, we're all about achieving your retirement goals and not chasing performance. And, we think that there's some big issues. So, but I think anecdotally, this is a perfect example. A new client of ours came on in October 26th of last year. The reason I know that is because I went back and looked at it because it blew my mind. He transferred over. We liquidated everything he had. And I looked at him and I called him up and said, listen, if you want to watch your account, you can, but I'm going to leave you in cash because I don't like where we're at right now. And I just don't feel like it makes sense to put you in here. So he was 100% in cash from October 26th to the end of the year. Okay. We redeployed his money February 1st. He left us on February 26th because we weren't aggressive enough. Now, over that period of time, he outperformed the S&P by 13%. Yeah. And we weren't aggressive enough. And that just typifies what I'm seeing everywhere. That's just one anecdotal story, but I'm seeing it everywhere. It's really amazing.
Well, okay, so we're gonna have to wrap up here. Before we do that, why don't people tell people where they can find you, what you do, and where they can catch your radio/podcast, because it's a definite must listen. And I really, after you listen to the Huddle, of course, you should go and listen to Know Your Risk Radio. So Zach, why don't you tell people where they can find you?
Yeah, so you can find us on Twitter at KYR Radio. And then you can go to our website, Bulwark Capital Management, bulwarkcapitalmgmt.com. You can also just Google Know Your Risk Radio. That'll connect you to the radio show website, which links to our main site. And then I think we've got a link on our site to get to our Apple or iTunes page. But I think the easiest way to find our podcast is with just Googling Know Your Risk Radio Stitcher. And we've had Kevin on a bunch of times. We're releasing a show with Jesse tomorrow. We've had Bill Fleckenstein and Luke Groman and Brent Johnson. And it's been, and I'm sure you guys can agree, certainly Patrick doing macro voices as well. One of the coolest things about it is just getting a chance to meet and talk to these guys. And I think there's some good stuff on there.
Okay, well, great.